Hello and welcome to Money Control. I am Kaizad Adajania. There's been a lot of news about negative yields and negative interest rates in European countries. So what does it mean for investors? What does it mean for depositors? And what does it mean for India? I have with me over here Joydeep Sen, who is a debt market expert, and he's going to de-jargonize negative yields and negative interest rates for us. Hi Joydeep, welcome to the show. Let me start by asking you the first basic question. What's the difference between yields and interest rates? And why are we seeing negative yields and negative interest rates in some European countries abroad?
Okay, so two very different issues. First, let's see what is negative yield and negative interest rate. So interest rate means if you, let's say, put money in a bank FD, you get an interest rate, say for example 7%. That's
Okay.
simple and straightforward. Now what is yield? Yield is your annualized return which you get on a bond, for example. Just to give an example, if you have a bond of a coupon of say 7%, you buy the bond for 100 rupees, you get 7% yield, annualized return.
Okay.
If you buy the bond for 110 rupees, as an example, you get less than 7%.
Okay.
Same bond, if you buy at say 90 rupees, you get more than 7%.
Correct.
That's the concept.
Correct. So basically, it's yield is basically the return that you make on your investment.
Yes.
And the interest is just the printed coupon that comes along with the
Exactly. Exactly.
instrument.
In fact, coupon itself means the annualized payments given to you.
Okay.
So your purchase price defines your effective return over the holding period.
I see. Okay.
Now coming to your basic question as to why things are negative in certain countries all over the world.
Yeah.
If we go back say 10, 11 years, the global financial crisis or the so-called Lehman crisis, what happened after that?
Okay.
Central banks all over the world, US, Eurozone, Japan, they cut interest rates
Okay.
and they pumped huge amount of liquidity,
Okay.
as in huge amount of money.
Okay.
Just to give a perspective on how much of money, just imagine if central banks were to pump $1 million
Okay.
per day
Okay.
since the birth of Christ.
Okay.
If you do the mathematics, 2019
Okay.
into 365
Okay.
into $1 million,
Okay.
that comes to less than $1 trillion.
Okay.
The amount of money pumped in, as per estimates, is $7 to $9 trillion.
Okay.
That's a huge amount of money.
Okay.
So where does the
And
money
that's
go?
been pumped in since the global financial crisis.
Yes, over the last 10, 11 years.
11 years.
So where does the money go?
Okay.
The money has to buy something.
Okay.
Money can buy equities, money can buy bonds, money can buy other assets.
Okay.
Now what's happening, bonds is like we just said, 100 rupees bond, if you buy for more than 100 rupees, your yield is less than 7% in a 7% coupon bond.
Correct.
That is what is happening.
Okay.
Equity markets are generally buoyant apart from some recent correction. So in the bond market, if a German bond, say for example, they call it Bund, let's say a 2% coupon German Bund.
Okay.
If you buy the same 10-year bond at say for example 130 rupees per 100, your yield is negative.
Yeah.
That is what is happening. So much of liquidity chasing a given supply of financial assets.
Okay. So the yields have been also now negative. The interest rates have been negative, but the yields have also been negative. So is that some kind of a sign that there's going to be recession in the future, or people are negative about the long-term state of the European economies?
Yeah. So to clarify here, in the US, the rate is 2.25%. Rate means the US Fed defined overnight rate.
Okay.
In the Eurozone, the overnight rate, which is equivalent of our RBI repo rate of 5.4%,
Okay.
the equivalent is actually zero, not negative.
Okay.
So the equivalent of our RBI reverse repo rate, which here is 5.15%, in Eurozone it is minus 0.4%.
Okay.
And in Japan it is minus 0.1%.
Okay.
So these are the central bank administered interest rates.
Okay.
Now coming to yield, estimates are globally $16 trillion, which is approximately 35% of outstanding stock of government securities globally,
Okay.
is in negative yield.
Negative. Okay.
Which means even if the bond carries a 2% coupon, given the price of 120, 130 or 140 rupees, effectively your yield is negative.
Okay.
So what does that mean? As you said, it means a recession may be forthcoming.
Okay.
So as per expert estimates, there is a 30 to 35% probability of a recession coming.
Okay. I see.
And just to clarify here, what is the definition of recession? The definition of is 2 consecutive quarters of negative growth.
Okay. Okay. So I'm going to go back again to negative interest rates. We've been hearing a lot of examples in the European countries where depositors, when they deposit money in the bank, they have to pay the money to the bank, and it's the other way around. When you want to borrow money from the bank, instead of paying interest to the bank actually pays interest to you. So isn't the whole logic is sort of turned onto its head. Isn't it a loss-making proposition for the bank in this case?
Yeah. So strange things are happening in the world. but it is not as prevalent. So as I said, in the Eurozone, the central bank administered overnight rate is actually zero, not negative. So the recent case was, this Jyske Bank, not Hindi Jyske, but Danish Jyske, Jyske Bank, they offered a product with allegedly negative interest rate, which means allegedly they are paying you to take money from them.
Yes.
But the reality is, if you look into the intricacies, they have certain, what should I say, charges. So effectively, per 100, you end up paying more than 100, even though it is apparently negative interest rates. So in a normal situation, even today, even in the Eurozone, if you keep money with a bank, you tend to get more towards zero than towards negative. And if you take a loan, the rate is more towards positive than negative. But yes, strange things have started happening. Just to give an example, recently in Germany, there was a long-term bond issuance, government bond issuance, with a defined negative yield.
Defined negative.
Yes, and they got 40% response, as in 40% of the subscription. Next day, the price went up, as in the yield went deeper into negative. So these strange things are happening in the world now.
So closer home domestically, I mean, do you see some of these things happening over here? Do you see the interest rates and negative yields, negative interest rates over here also?
No. Answer is no. The reason is, India, we are a growing economy. Our fundamentals are different, our interest rates are different, and our inflation also is different. Just to tell you something basic, what is interest rate? It is the cost of money. So as a growing country, we need money, which means somebody who wants money has to pay the cost of that money. Just to give an analogy, an adolescent person gains height faster, whereas a person in 20s or 30s does not gain height at that rate. That is the thing in India. So as a growing economy, we are structurally much different than the advanced economies of, say, Europe or US or Japan. So that thing will not happen in India.
So Joydeep, what's the impact of negative interest rates and negative yields on Indian markets?
So impact is there, but limited. Let me clarify why. It may seem that, globally nowadays markets being interconnected, something happening any part of the world happens and impacts any other part of the world,
That's true.
which is true. But why is it limited in India? The reason is, if you look at the holding pattern of securities, there are limits, and the extent of holding of FIIs of government securities in India is only 3 to 4%. And if we add corporate bonds, the holding is only 4 to 5%, which means the impact on markets is there, but limited. Secondly, impact is there on RBI policies. So RBI frames policies on interest rates depending on various factors like inflation, like GDP growth, including interest rates abroad. So there is an impact, or should I say sentimental impact, of interest rates abroad, which is negative now, on RBI policy formulation.
And finally, Joydeep, what's the impact on the equity markets? Because you earlier said that so much of money is chasing, borrowers are incentivized to borrow money, depositors are disincentivized to put money in the bank. So when so much money is outside in the hands of the public, does it find its way into the stock markets? Yes,
it does. So what is happening is, so much of money chasing financial assets. So price of those assets are going up. So in the equity market globally, barring some recent correction, markets have gone up. So what it means is, in a way, the equity market is ignoring the signal given by the bond market. So in the bond market, there is a 30%, 35% probability of a recession. So the equity market is ignoring that, and the equity market is generally going up, which means the equity market is signaling a bright future ahead of the global economies.
That's all from us. For more news, views and updates, log on to moneycontrol.com.